Hello and welcome everyone to day 3 of the 2024 US Expats Financial Conference, brought to you by AmericanExpatDirectory.com and sponsored by Expat Focus, the web's favorite destination for anyone moving or living abroad. We have a fantastic schedule for you consisting of 9 sessions over 3 days, covering multiple aspects of financial information for Americans living abroad, with perspectives from some of the world's foremost experts in their fields. Today is the 3rd day of the conference, and for this, our 2nd session of the day, I'm delighted to be joined by Melissa Groves from Bright Tax, who will be discussing how to minimize your US tax bill as an expat. Before we start though, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. Note also, while the conference is free to attend, if you'd like to leave a tip towards organizational costs, you can do so using a card at the PayPal link I'll drop into the chat window. Melissa will be answering your questions at the end, so please add them in the Q&A pop-up at the foot of your screen throughout, and we'll try to answer as many as possible, time permitting. So without further ado, over to you, Melissa.
Thank you. Hi, everyone. Thanks for being here with me today. As we said at the start, my name is Melissa Groves. I am a CPA registered in the state of Texas. I've been practicing now for a little over 15 years. My family and I moved to Germany 4 years ago. So for those of you that are also expats, I understand. And for those of you thinking of moving, I can sympathize with that as well. For today's session, we're going to break it up into 4 parts. In the first section, we're just going to set the foundation about taxes, who needs to file when. And for the second section, we'll go over how to minimize or avoid double taxation, reducing your US tax bill for the third part. And then I'll leave hopefully about 20 or more minutes for you to ask questions at the end. So let's set the foundation. Who needs to file a tax return? If you are an American, whether you're domestic or overseas, you are required to report your worldwide income. So that means for those of you that are expats, if your income is above the thresholds listed here, you are required to file a tax return. I want to call out specifically for those that are married filing separately. Those could be individuals who are married to non-Americans, so therefore they don't include their foreign spouse on the tax return. Your filing threshold is $5. So if your income is above that, you are required to file a US tax return. Additionally, if you're married filing jointly, $27,700. If you're single, $13,850. And if you're head of household, your filing threshold is $20,800. Please note that that changes if you're 65 or older, but in general, these are the numbers that you should consider. In addition to your income tax return, there's also a filing requirement for FATCA purposes, that's the Foreign Account Tax Compliance Act, and also for FBAR purposes, that's the Foreign Bank Account Report. The Foreign Bank Account Report gets reported to US Treasury, whereas the FATCA forming, which goes on Form 8938, that actually goes with your income tax return. The filing threshold for those, for the FBAR, it's 10,000 USD. And to be clear, that is all of your accounts. So the aggregate of all of your accounts together. So I have a lot of individuals that go, oh, well, only one of my account was over 10,000. So I'm just going to report that. That is actually incorrect. The reporting is for all of your accounts. So if all of them add up together equals 10, or just one account is 10, you have to report all of your foreign accounts. Similarly, for FATCA, that threshold it's dependent on if you're in the US or if you're outside the US. I assume most people are expats, so I'll focus on outside the US thresholds. But just quickly, if you're domestically in the US and your income is, your bank accounts are over 50,000 as a single filer, you have to file this form. And if you're outside the US, then if you're single and at the end of the year, your account is over 200,000, or accounts together is over 200,000, you have to file. Or if at some point during the year, it was over 300,000. And that would double if you're married filing jointly. When do we need to file? For domestic individuals, you need to file your return by April 15th. F-bars get an automatic extension to October 15th, but most people try to file by April. If you live outside the US, you get an automatic extension to June 15th. It's the 17th this year because the 15th is on the weekend. And both domestic and overseas individuals have the option to file an extension to give you until October 15th. Do note, though, that October 15th is an extension to file, not an extension to pay. So if there's a possibility that you might owe US taxes, the recommendation is to still get that paid in before you do, while doing the extension. And then for those that are living overseas, if you still need additional time to file for whatever reason, you can request additional time to file through December 15th. It will fall on the 16th this year. Now, I almost said fun fact, but it's not really fun, but it's a fact. Over 9 million people, or 9 million Americans, are living overseas, and several of them are still not filing. I think the statistic says it's about 10% that are actually reporting, and there are numerous reasons as to why they're not filing. For some, it's a lack of information. For some, it's misinformation or misunderstanding of the tax requirement. Some think they don't earn enough. Bad advice. I've actually had a few individuals that actually received documentation from written information from lawyers saying they don't need to file because they don't make enough. But as I showed you earlier, the threshold is what it is every single year. And some of these individuals were making over $50,000 and not filing. And then we do have a few individuals that we call accidental Americans. Mom and dad are American, or one parent is American. You were born overseas. They registered your birth abroad, got your social security number. Now you have a filing requirement. Or a few that I've also seen where mom or dad or both were stationed in the US or studied in the US, delivered baby in the US, baby now has a social security number and is an American and will be required to file. For those individuals, and even for Americans that live overseas that have not been filing, we have a good way to get caught up with your tax filing, and that is the streamlined filing procedure. The requirement for that is that you have to file 3 years worth of delinquent returns. So if a taxpayer is trying to get compliant now, they would be required to file calendar years 2020, 2021, and 2022 US tax returns. They would also need to file 6 years worth of foreign bank account report. And just a reminder, the foreign bank account report is disclosing all your accounts that will go to US Treasury. And that would be for 6 years. So I think that's 2022, 21, 20, 19, 18, 17. So from 2017 through 2022, and then 2020 through 2022 income tax return. In order to qualify for the streamlined filing procedures, you have, at least for there's the domestic and then the offshore. So to qualify for the offshore, you have to be outside the US for at least 330 days in one of the years out of the 3-year period. Additionally, you have to file a non-willful statement, which is pretty much acknowledging that you aren't trying to evade taxes, for lack of a better terminology. And also, you have to do it before the IRS contacts you. So if you've been contacted by the IRS saying, hey, we've noticed you haven't filed, or we're demanding a tax return, you can no longer use the streamlined procedure. And why is the streamlined procedure important? It's because it's a penalty-free way of being compliant. That is, if by chance, when you do file your return, you end up owing taxes, you will still have to pay the tax and the interest, but you can avoid any penalties that would come with that. A topic that I think a lot of people are curious about is, how do we avoid double taxation? A lot of individuals believe that, oh, I live in so-and-so country and they have a treaty with the US, so I don't need to file or I don't need to pay. While treaty law is great and it's helpful for some things, A thing to note is the savings clause, which pretty much trumps or supersedes the ability to exclude that income from being taxed in the US. So even though there's a portion of the treaty that might say this income will not be taxed, can only be taxed by the country you're living in, the US has a piece in there that says, well, we can pretend as though that verbiage wasn't there and the treaty doesn't exist and we can still tax it. So if you're ever in the position where you're thinking you may want to use treaty language, I really, really suggest consulting a tax advisor before proceeding. And actually, I should have checked with Hugo. I don't know if we're going to send out the slides, but if so, here are some other treaty sections that usually have some misconception. Now, how do I report my foreign income and what can I do to reduce my tax burden in the US? The two main options that taxpayers typically use is the foreign tax credit or the foreign direct income exclusion. The foreign tax credit is a non-refundable credit that you get to use the taxes paid to the foreign country to offset your US taxes. And the foreign direct income exclusion is where you can exclude as an expat up to X amount of dollars every year. For 2023, that number is $120,000 that you can exclude from being taxed in the US. And that number is subject to foreign inflation. Oh, sorry, I should point out, in addition to the foreign direct income exclusion, there's also the foreign housing exclusion, and that number is specific to your particular country and in some instances to the city. So I would recommend looking through the rules or better yet, consulting a tax advisor so they can help you with that. How does it work? The foreign tax credit versus the foreign income exclusion isn't something that we should take lightly. It is unique for every single person and your circumstances might be better to do one in 1 year and switch to something else in the following year. But please note that if you've been doing the foreign direct income exclusion and you want to switch to the foreign tax credit, you're not able to go back to the exclusion for 5 years. And so if you're ever making the decision on your own or you're talking with an advisor about making that decision, a good thing to think about is what are your plans for the next 5 years before making that decision. You might save taxes this year, but am I switching jobs next year? Am I moving to a different country next year or in 3 years? And if so, does it make more sense to pay a little bit extra this year to save myself on a tax burden later? But one thing to note for the foreign tax credit, that only applies if you're paying taxes to the foreign country. And this is for income taxes paid to the foreign country. Similarly, for the foreign direct income exclusion, it's important to note that you can only exclude earned income, that is salary, wages, self-employed income. You can't exclude your interest, dividends, or capital gains. And also for the foreign direct income exclusion, 2 more things that we have to remember is that you can either use physical presence tests, which is I was outside the US for 330 days. So it doesn't matter if I was in Germany for 20 days, I was in the UK for 50, I was in UAE for 183. It doesn't matter where in the world you were, as long as you weren't present in the United States or its territories. The other option is the bona fide residence test. This does matter where you are present. It's because I'm saying I am a resident. So in my particular case, I'm a bona fide resident of Germany. So if I were to use the foreign direct income exclusion, I am not limited necessarily to the 335 days like the physical presence test individual. But for me, the important thing is I am a resident. I'm a resident of Germany, paying taxes in Germany. And in my situation, it would be best to talk with my advisor as to whether or not I should use the foreign direct income exclusion or the foreign tax credit. Now, how can we reduce your US tax bill? Actually, something I should call out. Where was that? No, sorry. For those of us that are using the foreign tax credit, if you have dependent children, you could qualify for the child tax credit. For those individuals, there's both the non-refundable and refundable piece. The refundable piece is up to $1,600 per child that's under the age of 17. And again, that is subjected to, there's limitation based off your income, but you cannot use this if you're doing the foreign direct income exclusion. So if you are a taxpayer that you're living in a country where you've been paying taxes, but you've been doing the foreign direct income exclusion because it's easier, and you have a dependent child that you're claiming on your tax return, you could be leaving money in the hands of the government that you could put in your own pocket. So just something to consider. I also want to call out for my individuals that are self-employed. If you are self-employed, you most likely would be subjected to self-employment tax, which is 15.3% on the profits of your self-employed income. However, if you live in one of about 30 countries, I'll put them on the screen so you can see them. If you're living in one of these 30 countries, then you can use what's called the totalization agreement to avoid having to pay self-employment tax in the US. Interesting, if you're living in a country that's not on this list and you are paying self-employment tax, then yes, you do in theory get hit, or yeah, you get hit with double taxation, because you would have to pay your self-employment tax or your social contributions in the country you're living in. I'm gonna call out New Zealand because Australia is the first country and they're pretty close together. If you're living in Australia, paying taxes in Australia as a self-employed individual, then you will avoid US self-employment tax because you can use the totalization agreement. However, their neighbors, somebody in New Zealand, is doing the same thing, paying their taxes in New Zealand. However, New Zealand and the US does not have that agreement. So they would have to pay their contributions to New Zealand. And then when they file their US return, they would still have to pay that 15.3% to the US. But there are ways, let me be careful with how I say that. There are ways that you can structure and try to prevent some of your taxes or minimize some of your taxes. So it's best to be proactive, talk with an advisor, both on the US side and in your home country, to see what are the best options to structure your business to minimize your tax obligation. I do have a lot of individuals that they will talk to me about what it needs to look like on the US. And I always try to remind them, we also need to consider what it does for you in your home country, because it might be a great idea for the US and you're saving taxes in the US, but if it's opening you up to something worse where you're living, then that's not really a good option. And vice versa, it might be a great idea to open this corporation in your home country, but then we didn't consider what that does for your US tax obligation. So before you start a business in whether the US or in the foreign country, our recommendation is to always talk to your tax advisor. Which leads to this nice little slide here that talks about how to reduce your US tax bill and avoiding penalties. For those that have foreign companies or partnerships, or if you're invested in mutual funds overseas, you might be surprised to know that there are additional disclosures that are required with those entities or that structure. So it's important to, sounding like I'm repeating myself, talk to an advisor about what to do with those, because the company you created in Germany has a particular filing requirement on the US side, and failure to do that or failure to do it timely could result in some significant penalties. And that's the same thing for if you fail to report your foreign bank accounts, both to Treasury and to the IRS. And my last bit of tip for everyone that's here, if you haven't yet filed your past returns, it's not too late. you can still use the streamlined filing procedures to get caught up on your filing. And for those that have not received the COVID stimulus funds, if your income was within the threshold, you have until June 15th of this year if you're an expat. But if you're domestically in the US, you have to do it by May 15th to still file your 2020 return to claim that. And you can still file to get the 2021. For 2021, it was 1,400, and for 2020, it was 1,800. And if you have a dependent child, they would qualify as well for the third round, which is the 1,400, and there may be a small amount for 2020. So based off that, I will now move over. I actually got through that quicker than I thought. So we'll now open up for questions.
Thank you very much, Melissa, for the excellent presentation. And yeah, lots of questions to come in. Keep those questions coming to the audience, please, and we will get through as many as we can. So, Melissa, I'll dive straight in.
Please.
So what are the thresholds for 65 and over?
I honestly did not commit those to memory, but I am happy to find it and I can drop it in the chat for everybody to see.
Right, okay. If one files married separately, must one put foreign spouse's TIN on the return?
That is a question that is better answered individually, but on a high level, if you've made the decision to file married filing jointly, then yes, you would have to put their info. But if you're married filing separately, you don't have to. Well, you do need to list, if they have a taxpayer ID number, you do need to list it with their name. There's a section on the tax return that requires you to list the spouse's name and number.
Thank you. Here's a good one. Could you please explain whether FBAR and FATCA are just to declare accounts, or in addition, are these accounts then taxed?
It is just a disclosure document. That is a very good question. It's just a disclosure. They're not taxing you on the balance in your account. You're just reporting, I have this much money in this account. I would recommend, though, if you're earning interest on those accounts, be sure to disclose that or be sure to report that on your taxes.
Thanks. Another FATCA related one. Are the FATCA limits for income or for investment or savings accounts? So I guess that relates to the thresholds for filing. Do they relate to income or account balances?
Account balances.
Is the FATCA requirement for US and foreign held funds?
It is not for your US accounts, it's only for the foreign accounts. So any bank accounts you have with Schwab, JP Morgan, Robinhood, those do not need to be reported on the FBAR or FATCA. It's just the accounts that are outside the United States. So if you have an interactive broker's account, you need to report that.
Okay. So somebody asked, they have a godson living with them, and I think it sounds like a dependent in the sense they're paying his expenses and tuition. Can you file as head of household?
That's a little bit broad, but in general, if you're providing more than half of there's a technical terminology, but pretty much you're providing more than half of the support for the child and they're not being claimed by someone else, then you can claim head of household. If the individual is not a US person, then you would not be able to electronically file because they don't have a social security number. But you could paper file and claim and to be able to get the benefit of the head of household status, but you wouldn't qualify for like child tax credit if they're not American.
Thank you. Somebody wants a bit of explanation of what exactly income is. So they said several slides have mentioned income. What constitutes income? Earned by kind of endeavor, or if I cash out investments for spending money, or sale of a real estate, for example? Good
question. So according to the tax code, I remember tax 101, my first class, my teacher started by saying, everything is income and nothing is an expense except for. So the short answer is yes, everything you've listed is considered income. If you're working, the money that you receive from your employer is income. If you're doing a freelance gig and you just do some consulting or some small service, that's income. If a family member gifts you some cash, that's not quite income, but could be reportable. So think of it that way. Everything is income except for.
So if you sell something, yeah, I suppose when is it a capital gain rather than income? If you sell, property or investments.
All of those would be reportable, might not be taxable, but they're almost always reportable. So if you own a piece of property, we'll start with the easiest one, your primary residence. If you sell your home, you've lived in it the last 10 years, you sell that house, the gain on the sale is reportable, but it might not be taxable. There's a threshold where if the gain is below X amount, then you don't have to pay taxes. But if it's above, you pay tax on the difference. If it's an investment property and you sell it, the gain is reportable and probably taxable.
Thanks. Somebody says, can we use taxes on pension, social security income for foreign tax credits?
Ask me that one more time.
Yeah, I'm not sure. I'm not sure it's entirely clear. Can we use taxes on it probably means we use social security taxes paid abroad and claim foreign tax credits. So if you're paying social security tax in Germany, can you claim US credits on those? I think that's the meaning.
Okay, according to the tax rules, you use income taxes paid. And I want to be mindful not to step on toes because there are some countries where you get to include a little bit more than just the income tax. So for purposes of such a broad group and not knowing the specific country, I'm going to hedge and say you can use the income tax, but consult an advisor to see if there are additional pieces you can pick up, especially if you're in somebody like France.
Thanks. Yeah, there's more questions. Can you use foreign income exclusion for pension income?
No, because it's not earned income. And that it sounds weird to say, because you're like, well, I worked all my life to earn my pension, so there's not, but no, from a tax standpoint, that's not earned income. For the pension, the best option might be like trying to use treaty, but again, you'd have to look at the treaty rules between the US and that country. Or if you could do resource by treaty, or if you're paying taxes on that in the foreign country to get foreign tax credit. So that one depends.
Thank you. But you could, if you couldn't use foreign income exclusion for them, you could use foreign tax credits. Is that right?
Correct.
Which, because somebody else asked, are they both only applicable to earned income? But my right is saying, yeah.
Yeah, the foreign earned income exclusion is applicable to earned income. The foreign tax credit is applicable to foreign sourced income. So a good example would be if let's say I'm between the US and Germany. Germany is not really a good example because my worldwide income is taxable in Germany, but let's pretend that it wasn't. And I had some US income that wasn't being taxed in Germany. I couldn't use the taxes I'm paying in Germany to offset that US income.
Okay, question on capital gains tax. If we sell a house abroad, do we pay US capital gains taxes?
It depends. It's reportable and it might be taxable, but you do have to report it, yes.
Somebody says, what about dual citizens? Does everything still apply?
Absolutely.
So it's the same US citizen.
It's the same. As long as you're a US green card holder or US citizen, you have to report your worldwide income.
Somebody says, can I use streamlined procedure for FBAR only? I have filed tax returns every year, but never an FBAR.
It wouldn't be the streamlined procedure for the FBAR. So if you've been reporting your income, but you haven't done the FBAR, there's another procedure you can use. And I'm about to be embarrassed for not remembering the exact terminology. Delinquent FBAR submission procedure, that's what it's called. But I would caution that individual, if your foreign bank account had interest that you didn't report on your US return, you may need to go the route of the streamlined filing procedure, because you also would have to report the interest that you earned on the foreign account. But if you've done that piece, but just not done the FBAR, then yes, you would just use the delinquent FBAR submission procedure.
Thank you. Can you speak to the tax implications of an expat who is either a member or manager of a US-based LLC?
In terms of, that's a little bit broad. Can you ask the question again?
Yeah, so an expat who, for example, owns a US-based LLC. So I suppose, how is that reported?
It depends. That individual can choose to have it as a corporation. It could be an S corp. It could be a partnership if there's another owner. It could be a disregarded entity. So there are a couple of options. I would say best to talk with an advisor that focuses on US taxes, as well as an advisor for the country that you're in, to see what's the best option for you.
Is it taxed or reported differently if you're an expat or if you live in the US?
It's the same. So an expat or a domestic person can use their LLC in any of those fashions that I just mentioned. But the expat has some more benefits, to put it nicely, than the domestic individual. So like the foreign direct income exclusion isn't something that a domestic person has the option of, but an expat does. So how can I use the foreign direct income exclusion along with my US LLC and probably reduce my US taxes? I would say talk to a tax advisor.
Yeah, I think those situations with sort of corporations and things, yeah, it might be one to not try and file yourself. This is quite a kind of popular misconception, I think. How many days per year do I have to live outside the US to be considered a tax expat?
This is not legal advice or immigration advice, but from a tax standpoint, if you want to qualify for the foreign direct income exclusion, you have to be outside the US for 330 days. So I don't want to say living outside the US. I preface by saying being outside the US, because we have digital nomads, so they're not necessarily living in a particular country, but they're backpacking or doing whatever else, but they're outside the country, and those do qualify for the foreign direct income exclusion.
Fantastic. And I suppose the other thing, which I'm not sure, you're probably right, that was the gist of the question, but the other thing is, I mean, living outside the US for a certain number of days doesn't get you out of having to file US taxes.
No, absolutely not. Nothing gets you out of filing US taxes, except if my income is below the threshold that was on that first slide.
Got it. I think a couple of people have asked, about how to, if you'll be able to share the slides afterwards. And I'd say, get in touch with Melissa via brighttax.com and, request, and I'm sure they'll be happy to send those to you. Here's one, so possibly a brain teaser, or maybe it's an easy one, but if I use Wise has these sort of multi-currency accounts, and I think there's some other firms too, are those included on FBAR reporting? Where is the account in a multi-currency account?
That is a fun one, and we do get that a lot. And for purposes of a recording, I'm going to say you should disclose those, especially if it has foreign accounts associated. The USD portion is usually registered to a US bank, so like First Century or something. You don't need to disclose that, but the other ones, it's better to over-report than under-report, so we recommend just reporting it.
Because as you were saying earlier, there's no sort of additional tax implication anyway, so
right.
Yeah.
So why get a $10,000 penalty when I can just tell you, sure, here are all my accounts and let's just move on with life.
The $10,000 penalty is for not doing an FBAR.
Not in an FY, yes, sorry, not to freak anybody out, but yes, it does
Yeah.
carry that kind of penalty.
I'm not a US citizen. So yeah, no, but no, yeah, I think as you're saying, so the default is, if you're not sure, report it, because
Yeah.
it's the kind of safer. There are a lot of questions here. Are IRA and Roth distributions considered income, taxable income, I suppose?
They are reportable income, yes. If the question is, do they qualify for the foreign direct income exclusion? No. But the Roth distributions, Roth went in with post-tax money. So when you take them out, it's usually not taxable. So if you're at the age of retirement or the age that you qualify to take those distributions, there's typically no taxes involved. But again, recorded line, speaking out of context, I just want to say, speak with a tax advisor. But for the Roth, you should be fine. But your traditional definitely does need to be reported, and you may owe taxes on it depending on your overall income.
Somebody, this is one I'm going to answer, not in the sense of tax advice, but somebody says how to find a financial advisor. And Bright Tax isn't a financial advisor. It's a expat tax accountancy. And for expat financial advisors, if you look on the Expat Conference website, there you'll find some on there who specialize in financial advice for non-tax investment advice and financial planning for expats. If I have earned income and investment income, can I claim a tax credit for taxes paid abroad if I also claim the foreign earned income exclusion? So I guess they'd claim the foreign income exclusion on their earned income. Can they also claim tax credits for unearned income?
You can do a combination. I want to preface that. So with a foreign tax credit, let's say your income in the foreign country is exactly 120,000, and you pay taxes on that in the foreign country, but then you also use the foreign direct income exclusion. Then you've excluded 120,000 from being taxed, which is the amount of money that was taxed in the foreign country. So you now don't have a foreign tax credit to use because you can't exclude the income, but still keep the taxes that were paid. But using a different example, your income in the foreign country is 200,000. You're excluding 120,000, so you're still reporting 80,000. You could use a portion of the foreign tax credit on that 80,000, but the credit that you're using is not the full amount of taxes paid to the foreign country. So there's a portion of it that is now disallowed because you've used the exclusion.
Would it be, in that scenario, would it not just make sense to use just foreign tax credits?
It could, but so it's one of those where it depends on the math, right? I've had situations where, yes, the foreign tax credit is more than enough, but if you have other income that doesn't qualify for the foreign tax credit, you may, how do I put this without, it's a tax rate game. So if your overall income is at a certain threshold, your tax on your investment income gets to a certain threshold. So sometimes it makes sense to use the foreign earned income exclusion to reduce your taxable income, and that might make it more beneficial for other buckets that are being taxed. So some people just do exclusion, some people just do tax credit, and some people do a mix.
Thank you. A lot of those situations, I suppose, you ideally want to seek advice because it'll depend
exactly
on your circumstances. So an FBAR question, with the 10,000 minimum reporting threshold, do you convert currency into US dollars on the form? Yeah, because they're foreign accounts, so they'll be in different currencies.
You do.
And how do you know which exchange rate to use?
So there's two different exchange rates to use. The IRS gives you one to use for income purposes, but for the FBAR, we usually use Treasury's rate, and that is published. It's actually already available on Treasury's website, what the exchange rate to use is.
Somebody says, is it true you don't have to report foreign retirement accounts that have not been withdrawn from on FBAR and FATCA?
I'm gonna plead the fifth on that one, Hugo. That is a little bit controversial. There are different companies with different positions, and I'd rather not start a tax fire today. So I'm gonna, I'm gonna plead the fifth on answering that one and say, talk to your tax advisor.
Yeah. Am I right in thinking some foreign retirement accounts are reportable on FBAR and some aren't? And so again, yeah, it's sort of one for a tax advisor, depending on your which retirement accounts they are particularly. Okay, hold on. So if you reside in the UK permanently and only receive income from a retirement account that is located in the US, where do you pay income tax? In the UK because you live there, or US because the tax comes from there?
If you're living so our recommendation is to always file the foreign country's return first. So wherever you're living, file that tax return first and then file the US return.
But I've heard, and it's one of those things, it's hearsay, that some tax treaties, including the UK's, have provisions relating to retirement income. So is that something that could mean that you wouldn't need to, if that was your only income, you wouldn't need to file both returns? Depending on can the tax treaty affect that? I don't.
So in that situation, you would still file the US return and put the treaty. So there's a treaty form that you would file. And you would put that with the return to show that, yes, I did have income. It was above the filing threshold, but it's not taxable in the US because of the treaty. So my response would be you still file the return, but you include this treaty statement to show that.
Okay. Okay, Germany question. If I live in Germany as a retiree, no earned income, US pension and social security income, from US state and capital gains, distributions from investments held in the US. So I think there's a little confusion. Sorry, I'll read the whole question.
Sure.
If I live in Germany as a retiree with no earned income, but with a social security and US pension income, and the income stays below the $120,000 threshold, does that mean I don't have to pay US taxes?
Your retirement income does not count for earned income, so the 120 doesn't apply. So the 120 would be if you had wages, so you had an employer, you're being paid, but your retirement income is not earned income, so you still need to file because the 120 doesn't apply to you. But I also want to stay on that for a second, where let's pretend that all of that income was earned income and it was below the 120, you still need to file. So if your income is below the foreign direct income exclusion, so below 120, you still have a requirement to file a tax return to show that you're below the 120. So you file the tax return, you include the foreign direct income exclusion statement to show that you don't, but you still file. I want to make sure that's absolutely clear. If nobody else remembers anything else that I said today, remember Melissa said, even if my income is below 120,000, I still need to file a tax return if I'm above the thresholds. And if you go humor me here, I'm gonna throw the thresholds back on the screen. Here we go. So if your income is at or above these numbers, you need to file a US tax return. The 120 is for you to exclude the income. It's not for you not to file.
So you exclude it when you file, essentially.
Correct.
I see, yeah. Okay, another foreign income exclusion question. If you earn, for example, 200,000 US dollars, so above the 120, Does that mean you're doubly taxed on the kind of 80,000 above the threshold?
I don't know if they're paying taxes in another country, why they say doubly, but what happens in the US is the 200,000 minus the 120, the 80 that is left is taxed at the tax rate for 200,000. So let's pretend the tax rate for 80 is 10%. It's not, but let's just pretend for easy math is 10%. As a 200,000 income earner, your tax rate might be 15%. Again, it's not, but just for easy math. The 80,000 that's left over after the earned income exclusion is going to be taxed at 15%, not at 10%.
So if it is taxed abroad, I think that's the question. If it's taxed abroad the whole lot, and you can exclude 120 with the foreign earned income exclusion, are you double taxed on your income above the threshold?
Not necessarily. And this is one of those where I would rather look at the foreign income and see what the tax rate is. So for argument's sake, let's use the UK or even Germany. If you're living in one of those two countries and you're making 200,000, the tax that you're paying to the UK or to Germany is going to be a lot higher than what you'd have paid in the US. So you can use the foreign direct income exclusion and still use the foreign tax credit. But in those situations, I would probably recommend just using the foreign tax credit, because then you'd have credits carried over to future years.
Got it. Yeah. So the foreign tax credit's the way to, if you're being taxed abroad on it all, to avoid that double taxation. Somebody says, if retirement income is not earned income, what is it?
It's unearned income. I know it sounds really silly to say because you had to work to make it, but it's considered unearned income.
I suppose you're not working anymore, so you're not still earning. So yeah.
Right.
Okay, Ecuador question. Ecuador doesn't have a tax treaty with the US. Instead, they give a credit on US income taxes paid. So I guess they have a sort of foreign tax credit. So in this case, the expat should file their US tax forms first and then file for their local taxes, or not?
It's possible. I don't want to speak on that. I have seen that though, where the individual files file the US taxes first, and then they file the foreign, so that's not uncommon. So yes, if that's the situation, but because I don't speak to foreign taxes, I don't want to say that's what has to happen. But if that's what you've been advised by your Ecuadorian advisor, then yes, that's the way to go.
So there's no problem with that. It's the kind of works the same the other way around.
Right.
Would contributions from a US deferred compensation plan be classed as earned income? Can you use the FEIE?
Contributions from a deferred
compensation plan. So I guess that is a deferred compensation plan when you kind of earn possibly equity. If you've worked a certain amount of time or something.
I'm gonna defer
sure
that to a paid consultation with an advisor. One of us here at BITAX, or if you already have an advisor. I'm not comfortable speaking on that without all the information.
All the facts. Yeah, okay. Well, somebody says the bulk of my income is social security pension and IRA distributions. I file my US return first because my French declaration gives me a credit for the taxes paid in the US. So that's similar to the Ecuador one.
Yep, that's similar to Ecuador. Yeah.
Yeah. So is there any, I was going to say, in general, is there any advantage or disadvantage to filing your US or foreign taxes first?
So I actually have a case that I'm working on right now where the individual filed the US tax return first. They're in Spain, filed the Spanish return after. The Spanish advisor took a deduction for the taxes paid to the US, so pretty much using the foreign tax credit. But the Spanish authorities said no and removed that and forced her to have to pay. So pretty much what was paid to the US had to be paid to Spain. And now she's turning around to amend the US return to claim a credit for what was paid to Spain. So which is why we typically recommend filing the foreign return first. But if the country you're living in, so again, let's put the disclaimer, that doesn't work for everyone. So if your situation is different and it makes more sense to file the US return first, then by all means, go ahead and do that.
Thank you. So keep those questions coming. We've got a few more minutes. A few sort of comments here. Oh, look, the question on the deferred compensation is similar to an IRA. So I guess it's a deferred taxation.
Is it like a
Retirement plan,
pension
perhaps.
or a retirement plan? Okay, then yeah, it wouldn't qualify. It's not earned income.
So let's have a look. There's one here, it's quite specific. Okay, if my only income in the year was a US home sale for $500,000, what was the tax situation there?
If your only income for the year was the sale of a US home for $500,000, you have a reporting requirement. Whether or not you will pay taxes on that is dependent on a couple of factors. Easiest would be if that was your primary residence for 2 out of the last 5 years, it wasn't a rental property. Is the 500,000 the gain or the sales price?
I don't
We
have
don't
that
know.
information.
Well,
No.
let's
I think it's the
pretend
sales price actually.
at the sales price.
Yeah.
So if that's the sales price, it would be the 500,000 less whatever you originally paid for the property. So let's say it was 350,000 and you made no improvements before selling it, your gain is 150,000. If it was your primary residence for 2 out of 5 years, that 150 would be reportable, but it wouldn't be taxed. So.
Okay.
But you'd still have to file a tax return to show that. Otherwise, you might get a failure to file notice from the IRS.
So it depends on the original, on the capital gain
Right.
rather than the sale value.
Right.
Got it. So another one about sale of a home. If your country of residence exempts the sale of your family home, this is presumably, you sold your home abroad, as it were, from capital gains taxes. Could a tax treaty apply, or do you still have to pay the IRS?
You would only pay, so if it was your home, let's assume this is a single person or married filing separately. And the gain on the house was 500,000. So now the sales price, but the gain, half of it would be to you and half to your spouse. Your 250 would be reportable, but not taxable. Because in the US, if it's the sale of your primary home and you've lived in it 2 out of the last 5 years, you get to exclude up to 250,000 as a single person, 500,000 as a married couple. So if it's that or below, there's no payment. If it's above, then you would pay tax on the difference. So if your portion of the gain is 300,000 and you're single or married filing separately, you'd pay tax on 50,000.
So essentially, it doesn't matter if you're selling it in abroad or in the US. It's kind of the rules apply globally.
Correct.
Here's a good one. Can extensions be filed both by snail mail and online? I've only ever done it by post.
It can be done online. You can do by post, either one. I do know individuals that do both, just like as a fail-safe, but you don't have to. You just need to do one. But the December extension or the extension to get for the December 15th deadline, that one has to go by post. And it's not filed by December 15th. It needs to be received to the IRS. Or sorry, it needs to be received to the IRS in order for them to qualify that one. So, yeah.
Okay, question on the streamline procedure. If you plan to do streamline procedure to catch up on past taxes and also filing for current year, do you have to do it all at the same time? Or can you do one on time and the others on extension?
So you can extend the current year. So assuming you're getting caught up this year, the 2020 and 2022, you can get those files now or start the process now, and then file an extension for your 2023 to give you until October 15th.
Thank you. There are a few questions on sort of how to get in touch. So is that via the Bright Tax website?
Yeah, the Bright Tax website.
Do you want me to drop that
Yes,
into?
thank you.
Yeah.
I was about to do it, but thank you.
So that's brighttax.com. I've just dropped that into the chat. So yeah, if you have further questions we haven't had time for, or want to talk to someone about your US taxes, then yeah, go to brighttax.com and get in touch there. Any tips on how to review the draft of the tax documents from your accountant?
Ooh, good question. I like that one. Yes, make sure you know what the numbers mean and why they're there. If all you have are wages, then you should only have numbers showing for wages and taxes paid. If there's a number, I said you should understand the numbers, but at the same time, you don't need to know all of it, but the basis of the basic numbers need to make sense to you. So if it says I owe tax of 20,000, you need to understand what's driving the tax, not necessarily the tax rate, but understand I'm reporting my interest, I'm reporting my dividends, I'm reporting my wages. And if you have a good accountant, they'll be happy to sit with you and talk about it.
Thank you. There are a few questions on PFIX, but I'm not sure we have time to get into that.
No.
I was going to say, well, we have another session coming up in about an hour on sort of US taxes relating to investments particularly. So join that and there'll be the opportunity to ask questions then too. Let's just do, coming up for the hour, let's do one last question. What is the standard deduction for expats on the 1040?
The same as it is for somebody locally in the US. It's $13,850 for single, $27,700, I believe, for married filing jointly. And married filing separately is the same as single, $13,850.
Right. There are questions about specific kind of pension plans and things, but we are coming up to the hour, so that's more or less all we have time for. Melissa, thank you very much for that excellent presentation and for answering loads of questions.